Hi everybody, it's Kim from Inside My Money. One of our people has asked about showing a video on how to do mortgages inside of Homebank. So I've got a couple of things that I can show you today. What we're going to do is I'm going to show you, first of all, in a spreadsheet. I've got a Google Sheet that you can use, and that shows you how the interest is calculated and the repayments are done. Now remember, I'm talking about how this is done in New Zealand. I don't know if it's different around different parts of the world, but just remember this is applied to the New Zealand system. So I'll show you how it's done in the spreadsheet, and then we'll create the mortgage. I've created the mortgage already, but we'll just go through and show you how to create that in Homebank and put in your repayments and your interest, and then you can see how the principal is calculated, because it's just really the difference between a couple of balances when you see it in your bank statement and your Homebank, but I'll show you the background of it in the spreadsheet. So let's jump across first of all to the spreadsheet, and again, like I said, I've put it into a Google Sheet, and I'll make this available as well so that you can have a play with it. Okay, so what we've got here is just a very simple mortgage of $100,000. So you've got an interest rate of 7.5%. And just let's assume that this is a fixed rate mortgage. If it's a variable, if it's a floating rate and the rate changes, then this is not going to be as accurate because you will obviously have changing depending on when the interest rate changes. Then it's your repayment amount, and it can either be weekly, we've got a drop down here, or it can be fortnightly, or it can be monthly. Now, in our system in New Zealand, banks calculate the interest daily, and then they allocate it to your account either weekly, fortnightly, or monthly. With my mortgage, we pay weekly, so the interest appears on my bank statement every week. So you can see the interest that's come in and been added to the balance, and then less the repayments that are made. And then I've got for the number of days in the month, whether it's obviously 28 or a leap year, or it's a 30 or 31 year 31-day month. So the first thing you're going to do is put in these numbers. So you should be able to just put in if it's 150,000 or 400,000 or whatever it is. Then just choose your interest rate. Now remember to put it in, don't put it in as 7.5. Well, you should be putting it as 0.075. Even though this is a percentage, you should be able to then just go up and change that. And then put in your amount, and just let's say they're paying $215 a week, and then there's 31 days, and we'll just use January for example. So just a few little explanations underneath. Again, we're allowing for the fact that the interest is charged daily. Then also it assumes that if you're making a repayment, then on the day that the repayment is going in, I'm assuming that the repayment goes in first and then the interest is charged on the balance after that, not that it's charged on the balance plus the interest. So that's why, and this is a very simplistic view of it, your final amount will be different in the actual banking system, but this is just to give you an idea of how it works. So we've got the opening balance of 100,000 less any money you repaid on that day, plus the interest that was charged, and then the closing balance, which is obviously the remaining amount. I've got that for up to 31 days. So you can see here that once a week, and again, it's keeping it simple, it's just a total of 31 days. It's not a specific month, it's just an actual number of days. So on day 7, then we make a repayment because we're paying every week, and so we get obviously a lower balance. So the balance will increase every day up until the day that we make a repayment, and then it goes up again and we make another repayment, and so on. So we've made a total of 4 payments there, 1, 2, 3, 4. Sometimes you're going to make a total of 5 repayments in a month. If you're doing weekly, that's why you're going to repay your mortgage off faster if you pay weekly, because you get 5-week months, and because you're paying weekly, obviously you're going to make those extra repayments every time that happens. So what you've got then at the bottom is the total payments made. The total amount comes to 860. The total interest that was charged is 636, and then the principal that you've paid off is the difference between the total amount, because the amount you're paying should be principal and interest. So then obviously if you take the total amount minus the interest that you've been charged, that's the principal that you've paid off. The other way of calculating that is just to say, well, we started out with $100,000 owing $100,000. Now we owe $99,776. The difference is $223 that we paid off in that month. If you increase your payments, say you're paying $350 a week, then obviously that total principal that you're paying off is going to go up, and the number of years it's going to take you to clear that $100,000 loan is going to come right down. So that's how you can look at it from a day-to-day, month-to-month point of view. So if you really wanted to keep things simple, then when you see your opening balance at the beginning of the month in your bank statement, you could put that in there, and then you could just see how close you're getting and how it's working to the closing balance at the end of the month. So we'll leave that spreadsheet with you and you can have a play around with it. Now we'll put it into Homebank. So we'll just move that one out of the way. So what I've done is in our fictitious characters, I've created the fixed mortgage. So this is a liability. So what you would do is you would go up, you go to Manage, Accounts, and then you just create a new one. Make sure it says liability because it's a debt. Then I've just put in what the minimum payment is. We'll just actually round that to, well, I think it's 200. Yeah, we'll leave it at that. And then that's the interest rate, just so that I know. And it's a fixed mortgage for this point. You could also put in the term of the fixed mortgage when it ends. So that's how you set it up. Now, because it's a liability, you have to start with a negative balance because obviously it's money that you owe. So then when it comes to setting up your payments, you go down to your schedule area at the bottom here and you're going to set up a mortgage repayment. So we're going to put it in, it's a transfer because the money is going to come out of one of your other accounts, everyday account, joint account, whatever account you want it to come from. It's going to go onto, so your everyday account will obviously go down by $215. Your mortgage will then also go down by $215. So it's not going to look like you're saving any money because one account's going down and the other one's going down, but you are actually doing better because you're paying off your mortgage. You can call it loan repayment, but I'm going to call it mortgage repayment. And then I've categorized it here under mortgage and loans and mortgage repayment. So if you just click OK, and then the schedule part of it is starting on the 1st of December because we'll backdate this to show you how it works, and it's one every week. So yep, every week, every 7 days, this should occur. So if you're wanting to create those categories, again, remember you're just going to you should already have one for loans, but otherwise you just go create, and then you'd put in your new main category to be mortgage, and then hit enter, and then your subcategories, one will be mortgage interest and the next one will be mortgage payment. Now I've got a combined one of mortgages and loans here because our characters used to have a personal loan, but now I'm just going to show you the mortgage part. So what we do then is we're going to post our scheduled repayments. It's not the interest because you're going to have to put the interest in yourself, but we're going to post all of these. So I'm just going to post and just keep posting, and it's going to just keep close out of that, just keep post, and it's going to go into January, so I'll stop for December. So then we click on the mortgage, and already you can see by posting those repayments the amount we owe has gone down, but of course there's no interest in there. So then to get the interest in is you're going to export your bank statement information for your mortgage. Now that will bring in the repayments and the interest, but what it should do is because the repayments are already in there, it should cancel those ones out. It should delete them when you import everything. So you just do an import into here like you would with any of your other accounts, and that will bring the actual interest in. If it doesn't work or you want to do it manually, then we're going to add in our interest in the normal way. And remembering that now our transaction buttons have moved down to the bottom here, so we're going to go add, and we're going to go, this is an expense, not a transfer, and we're going to pick our dates. So this was the first, this came in on the 1st of December was our first lot, and then we will go negative. Let's just say our interest, I'll just check my little spreadsheet. Okay, and it was, let's just say it's minus 110. Minus 110, fixed mortgage, the payee, again I'm just going to put the bank. And then we're going to categorize it as mortgage and loans mortgage interest. And we go add and keep. And then we can do the exact same thing, but all we're going to do now is we're going to change the date to be the 8th. Add and keep. And then this next one will be the 15th. Add and keep. And I'm just replicating what you're going to do when you import. So you shouldn't have to do this part when you import it straight from your bank statement. Add and keep. Right, so now we're going to do a calculation to see how much we've paid in total, our total repayments, how much we've paid in interest, and how much we've paid in principal. So to find our total repayments, we've paid $215 times 5. So each week we paid $215. There's an extra one in there because our very first repayment for December was right on the 1st of December. So obviously then if we keep going all the way to the end, we're going to have to pay an extra one because of the extra days in the month. So our total repayments is 1075, but of that we had to pay the bank back the interest, which was 5 lots of $110. So minus 550. So our actual amount that we've cleared on the debt is $525. So that's how you calculate that. Now what you can do instead is you can simply go, we owed $100,000 at the beginning of the month, minus we only owe $99,475 at the end of the month, therefore we've paid $525 off this debt. What you can also look at is the reports. So if we go trend time and we've picked our fixed mortgage and we've done it for the month of December, you can see here same numbers that we just talked about. Everything that we paid was $1,075. Now because we're looking at the mortgage, remember this treats it like income. It's not, but it's just this is the positive part. So this is the amount of money going to reduce the debt. The expense part is the interest that the bank's charging us, and the total is the amount that the debt's going down by. So we can look at it as just those amounts there. We can look at it as this graph, which shows us that here's the amount that we have repaid in principal, or we can show it as a bar graph. Now this is looking pretty sad because it's just 1 month, but you get 12 months along here, and what should happen is all of these graphs will go up and up and up and up, because as the balance goes down, the amount of principal that you're paying goes up. If the interest rates drop, then the principal's going to go up. If the interest rates go up and you're paying the same amount, then your principal is going to come down. You won't be paying it off as fast. Now, what's another report we could look at? Let's have a look at balance. Move this one over here. Again, this is a different picture. Beginning of the month, we owed $100,000. Now remember, this isn't going to say $100,000 here because this is assuming it's at the end of that day or that week when interest and repayments have been applied. So it's actually $100,000. When you get to January, this is your opening balance, and then by the end of January you'll get your closing balance. So we can look at it there. That looks completely odd, so I wouldn't use that one, but this one's quite a good one to use. So then we can interval, we can say by month, and it will show you that. You can do it by week, and by day it's not going to show you any different. So that's that report. We could also, I think those are pretty much, then statistics is just your standard one that you would look at. If we squish all these down, because we don't want to see all of those, here's mortgage here, and that's just going to give you the transactions. It's going to give you the mortgage interest. Now, it's not going to show you the repayments, because those go in and come out, or go out actually and then come in. So it's not going to show you the transfers, because they are basically zero, because your everyday account is going down by 215 and your mortgage is going down. So you're not going to see that specifically. But if you look at, there's your fixed mortgage there, again you can see it from a different point of view. But I think the best one to choose would be this trend time report, because over time it's going to give you a good picture of the amount of principal that you're repaying, and you'll be able to see how interest rates affect you. It's particularly good if you're on a floating or a variable rate interest rate, and then you can see month by month or every few months, if the interest rate changes, how your principal's changing. This is for a fixed rate, so it's quite easy. So that's how to do mortgages. I will give you the link to the Google Sheet at the bottom as well, in case you're interested in the daily side of it. If you've got any other questions, please give me a yell. Happy to answer questions, happy to do more content. Good luck, and I'll talk to you again soon.